In this video, we will demonstrate how you can calculate for the corporate cost of capital. So the corporate cost of capital is the return that the business can earn by investing in alternative investments, such as stocks and bonds, that have the same risk its own real assets have. So in this case, each firm will have its own as a target capital structure, and the target weights. These are used to estimate the firm's corporate cost of capital, or CCC. So the formula we will use is this formula here, where corporate cost of capital, or CCC, is equal to this, looking at the cost of capital plus the cost of equity. Right? So cost of capital will be calculated as your cost of debt, or your target capital structure, which is WD, multiplied by your marginal before tax cost of debt, or RRD in this case, and then also multiplied by your after tax calculation there, which is 1 minus T, because where T is the tax rate. So once you have this, you also need to calculate the cost of equity, which is your WE, the target capital structure, equity, multiplied by your RRE, or the cost of equity, or the marginal cost of equity. Right, so let's look at an example there. So the example here, what we first example is we look at assume a facility as a target capital structure, as you see below, where the target capital structure is 30% debt and 70% equity. The hospital is also planning to finance a new project with 50% debt and 50% equity. The marginal before tax cost of debt is 8%. The tax rate is 35%, and the marginal cost of equity is estimated to be 14%. So what is the organization's corporate cost of capital, rounded to the nearest tenth of a percent? And so using our formula, we can put the equation here, where our cost of debt is 30%, or 0.3 here. Your RRD, or before tax cost of debt, is 0.08, multiplied by 1 minus the tax rate of 35%, is, so you have 0.65. Calculating this, you get 0.0156. On the other side, we look at the cost of equity, where we multiply the WE, or the target capital structure equity, times your cost of equity, or RRE, which is 0.14, and you get 0.098. Adding this to, you will get the answer of 0.1136, or 11.36%. Okay. Another example, let's take a look at that, is to look at this situation where health services organization, target capital structure 20% debt and 70% equity. Its cost of debt estimate is 10%, and its cost of equity estimate is 16%. It pays federal, state, and local taxes at a 40% marginal rate. So what is the firm's corporate cost of capital? Right, so entering the information as follows. We use the same formula. So now we know that your WD, or your cost of debt, target capital structure debt, is 20%. Right. Your RRD, again, which is your marginal before tax cost of debt, and enter that as 0.1, and your tax rate of 40%, so 1 minus 0.4. So when you calculate this, you get 0.012. On the other side, you add your cost of equity, so that will be 0.8 for 80% equity and 0.16 for your cost of equity estimate. You get 0.0128 here. So adding these two up, you get 0.14 or 14%.